Oh, welcome again to another Options Trading Minute. I'm your host, David, and as always, the information provided here comes from Patrick Ceresna, Chief Derivative Market Strategist for OptionSource.net. In this Options Trading Advanced series, we're going to discuss in deeper detail the option Greeks. Now, as a quick review of the last video, the variables in option pricing. The option price is determined by the price of the underlying, the strike price of the option, the amount of time until expiration, the volatility of the underlying, any dividends outstanding, and the current risk-free rate of interest. So why do experienced traders care about the option Greeks? It is because they are a valuable tool in predicting what will happen to the price of an option as the market variables changes. This may seem difficult to comprehend at first, but option prices do not move exactly with the price of the underlying asset. However, any trader that dedicates the time to learn the essentials will begin to understand what factors contribute to the movement in the price of an option and what effect each factor has. Many professional traders will use the option Greeks to effectively manage a portfolio of multiple options at a variety of strike prices over a variety of time frames. In order to create a neutral portfolio, market professionals will also use the Greeks to ensure that their market exposure is effectively hedged and adjusted accordingly. As for the average trader or investor, the Greeks represent a means of understanding why and how an option's price changes as any one of the variables change. The five commonly referred to option Greeks are the delta, which measures the correlation of the price change in the option to the price change of the underlying; gamma, which measures the rate of change of the delta; vega, which measures the change in volatility; theta, which measures the change in time; and rho, which accounts for the change in interest rates. The first most commonly referred to Greek is the delta. As mentioned, the delta is the rate of change in the option price relative to the rate of change in the underlying stock. This is important to understand since many option strategies are tailored to profit from correctly anticipating the price change of an underlying security. In this example of delta, we have a stock that is priced at $50 and an at-the-money option at the $50 strike. There are 30 days until expiration. The call option is priced at $2.32 with a delta of 0.53. The delta reflects the expected change assuming no other variables change. If the price of the stock increases by $1 to $51, we can anticipate that the call option would increase from $2.32 to about $2.85. In the same respect, if the stock price was to drop from $50 down to $49, we can anticipate that the call option would decrease in value from the $2.32 to about the $1.79. Some of the key characteristics of the delta are: as a call option becomes deeper in the money, the delta will approach 1. Call options always have a positive delta. At the point that the option delta reaches 1, the call option would start replicating the price movement of the underlying stock almost dollar for dollar. When we are looking at the delta of put options, the deeper in the money the option gets, the delta will approach -1. Put options always have a negative delta. The next option Greek is the gamma. Since the delta is always changing, there needed to be a way to measure that progressive change. As a result, the gamma was created as a means of quantifying the rate of change of the delta. This is primarily utilized by professional traders to adjust delta-hedged portfolios. The next Greek is the vega. The vega is the measure of the change in the option price relative to the percentage change in the implied volatility. In this example of vega, we have a stock that is priced at $50 and an at-the-money option at $50 strike. There is 30 days until expiration. The call option is priced at $2.06 with an implied volatility of 35% and a corresponding vega of 0.057. If the implied volatility of the stock increases by 1% to 36%, we can anticipate that the call option would increase from $2.06 to approximately $2.12. In that same respect, if the implied volatility was to drop from 35% down to 34%, we can anticipate that the call option would decrease in value from the $2.06 to approximately $2. The next option Greek is theta. The theta is the measure of the change in the option price relative to the change in time to maturity. Every day that passes, the option will lose some of its value. The theta measures that rate of decay. In this example of theta, we have a stock that is priced at $50 and an at-the-money option at the $50 strike. There is 30 days until expiration. The call option is priced at $2.06 with a theta of minus 0.041. If the number of days until expiration drops from 30 to 29, the option would decrease from $2.06 to approximately $2.02. The final option Greek is rho. Rho is the measure of the change in the price of an option relative to the change in the risk-free rate of interest. This particular Greek is far more relevant on longer-term options, as the interest rate effect on the short-term option is less evident. In this example of rho, we have a stock that is priced at $50 and at-the-money option at the $50 strike. There is 30 days until expiration. The call option is priced at $2.06 with an interest rate of 3% and a rho of 0.02. If the interest rates were to rise to 4%, the option price would increase from $2.06 to $2.08. In the same respect, if the interest rates were to drop from 3% down to 2%, the option price would decrease from $2.06 to $2.04. In conclusion, by learning the option Greeks, an investor or trader is able to understand why an option is or is not moving in correlation with the underlying security. By understanding the variables that influence option prices, the investor will have the confidence necessary to integrate options into their portfolio and take advantage of many strategies to help meet their objectives.